Hi, I'm Jimmy Atkinson, founder of the Opportunity Zones database at OpportunityDb.com and host of the Opportunity Zones podcast. And welcome to today's webinar, Opportunity Zone Investing in Silicon Valley. Today's webinar is sponsored by Urban Catalyst, and I'm pleased to be joined by Urban Catalyst's founder and managing partner, Erik Hayden. And I'll bring in Erik in just a moment here, but first, some of the things that Erik and I will be discussing today include the investment opportunity that the tech migration currently underway in Silicon Valley provides for geographically focused Opportunity Zone projects in downtown San Jose. We'll also discuss the Silicon Valley job engine driven by Google and Adobe, among many others, real estate supply and demand in San Jose's Opportunity Zones, and in particular, real estate market trends and construction trends in the wake of the COVID-19 crisis. We'll also discuss, toward the end of Erik's presentation, he's got details on his 7 Urban Catalyst downtown San Jose projects, all located within Opportunity Zones. And then most importantly, we'll discuss how you can incorporate this type of investment into your investment portfolio. Before we officially get going today, before I turn it over to Erik, a couple things to keep in mind. As I mentioned a minute ago, yes, this webinar is being recorded, and everyone who registered will receive access to the video recording. We're going to send an email out tomorrow afternoon with a link to the recording so you can view it again. And we will also have time for a Q&A session at the end of today's webinar. Probably try to leave about 20 minutes or so toward the end. So if you do have a question that you'd like to ask our expert, Erik Hayden, please use the Q&A tool in your Zoom toolbar. You can use the chat feature as well, but it helps me out. It helps Erik out a lot if you can use the Q&A tool. It's easier to manage the questions that way. Also, throughout the webinar, we're going to ask you some questions. We've got 3 poll questions for you today that are a lot of fun to get a little bit more information from you and a little bit more interactivity to make it a little bit more interesting. So now it's my pleasure to introduce today's speaker, Erik Hayden. He is founder and managing partner at Urban Catalyst. Erik, please take it away.
Hey, thank you so much, Jimmy, and thank you everyone for joining us today. Really excited to be presenting to you. You know, obviously with any presentation like this, we have disclosures and risk factors, so I wanted to go through those just briefly. You know, Urban Catalyst, we are a real estate equity fund that is focused on ground-up real estate development in San Jose, California. We're also an Opportunity Zone fund, which is, of course, why we're talking with Jimmy today. And, you know, being an Opportunity Zone fund, that makes it possible for us to give our investors the tax benefits associated with the Opportunity Zone program. Today, I'm going to talk a little bit about the Opportunity Zone program itself. You know, what are the tax benefits? You know, how do you qualify for them? I'm going to talk about why San Jose, you know, why is Urban Catalyst doing business in San Jose? Why is now the time to do ground-up real estate development? I'm going to go through specifically our portfolio of 7 projects, a very diversified portfolio. So we'll go into a lot of detail with each of those. And then finally, I'll talk about our team and our experience as developers and fund managers.
All right, thank you, Erik. And before you move on, I do want to interrupt you real quick. I want to throw up this first poll question for our audience. As you know, the Opportunity Zones incentive is a capital gain incentive. So if you're going to invest in an Opportunity Zone fund, you need to have a capital gain in order to take advantage of the tax benefits. So we wanted to know, what is the source or sources of your capital gain? And you can select more than one here. We want to know if it's from the stock market maybe, or from real estate, or maybe you sold a business, or a little less common, maybe you've got some collectibles, some gold, some jewelry, some art, or maybe even Bitcoin or other crypto assets. So we're going to give everybody just a minute to take a look at all those options there. And again, you can select more than one if you've got capital gains in more than one category potentially. Also, if you haven't recognized a capital gain yet, that's okay. We're just more interested in knowing maybe potentially down the road, if you do recognize a capital gain, where is it likely to come from? So we're going to wrap up this poll question here in just 5 more seconds. So get your answers in quick. And we're going to end the poll now, and I will share the results. And we do have more than 2/3 of our respondents saying that they do have capital gains from publicly traded securities, the stock market primarily, I would imagine, through the holdings of stocks, bonds, ETFs, mutual funds. Half of the people in the room also have capital gains from real estate, and then a fair amount, about 1/3 of our folks here today, privately held business. and non-zero answers from collectibles and Bitcoin as well. So that's interesting. A little bit of everything. Does that surprise you, Eric, or is that about what you expected to see?
Jimmy, this is almost exactly what I expected to see. That is almost the exact profile of the over 150 investors we have in our fund right now. Stocks leads the way, followed by real estate, and then the sale of a business. So interesting that the market is exactly what we thought it was.
There you go. All right. Well, Eric, please continue. I'll try not to interrupt you too much more going forward here.
Sure. So, really before I get started into everything, I want to show everyone, we've been featured in the press quite a bit in the last 18 months. We've had over 100 news articles written about us, just getting a lot of positive buzz about what we're doing in downtown San Jose. But what I'm most excited about is we were recognized by Forbes magazine as one of the top 20 Opportunity Zone funds in the country. And that was, out of over 100 applicants. Really just national validation from Forbes that we're doing things the right way. So in order to get the tax benefits associated with the Opportunity Zone program, you have to have eligible capital gains. We just went through this with the poll. There are 3 primary types of capital gains events: the sale of stock, the sale of a business, the sale of real estate. We call investors that invest in our fund, it's an event-driven investment where they have to have a capital gains event in order to receive the tax benefits. So if you have one of these events and you invest into an Opportunity Zone fund within 180 days of that event, you're eligible for the tax benefits. There are 3 primary benefits. The first is you're able to defer paying your capital gains taxes for 6 years. So you really don't have to pay taxes on that capital gains event until April of 2027. When you pay your taxes in 2027, you get a 10% discount. So for every $100 that you would have owed in taxes, you only have to pay $90. These 2 benefits are really what is initially what people think about investing into an Opportunity Zone fund. It's kind of what they get interested in. But it's really the third benefit that is the biggest benefit, and that is after investors' money seasons in our fund for 10 years, our plan is to sell all of our assets, liquidate the fund, and return all of those profits to our investors tax-free from a federal capital gains perspective. So those are the big 3 benefits for investing into an Opportunity Zone fund. There are other benefits, smaller ones, and we'll go through those in later slides. So to give everyone just an overview of the Bay Area, here in green, we have the Opportunity Zones that are located in the San Francisco Bay Area. There's census tracts, and in general, lower income census tracts. San Francisco received 11, Oakland received 28, and San Jose received 11. Here's a close-up of the San Jose Opportunity Zones. You can see almost all of downtown San Jose is covered by 4 census tracts that are Opportunity Zones. What's interesting here at Urban Catalyst, when I formed the company in 2018, my plan was to form a real estate equity fund and do ground-up development in downtown San Jose. And I wanted to start this company because I saw the overall macroeconomic trends throughout Silicon Valley really pointing towards downtown San Jose as the next place to really do ground-up development on a large scale. And it was only after I started forming Urban Catalyst that I learned about the Opportunity Zone program and thought, boy, everywhere where I'm planning to do development anyway is already in the Opportunity Zone. I might as well give my investors the tax benefits associated with this program. So really that's how Urban Catalyst became an Opportunity Zone fund. In downtown San Jose, we've been developers for quite some time throughout our entire careers, doing development all over the Bay Area. And in downtown San Jose, we have the 3 things present that we look for whenever we do development anywhere. And I'm going to go through those really. The first is we want to see a demand for all of the different types of projects that we're building. And that demand in downtown San Jose is really driven by the Silicon Valley job engine. We want to have transit and physical infrastructure already in place. Downtown San Jose is the only true urban environment in Silicon Valley. Downtown San Jose has Diridon Station, which is slated to be the largest train station on the West Coast. It already has multiple modes of mass transit that connect to it, including Caltrain, and very shortly here, BART. BART is the medium gauge rail system that goes throughout the Bay Area. It's fully funded to connect through downtown San Jose to Diridon Station over the next several years. San Jose State University, boy, you really can't talk about downtown San Jose without talking about San Jose State, because it's located right in the heart of downtown. With over 35,000 students, San Jose State is the second largest university in the Bay Area behind Cal Berkeley. And a little known fact about San Jose State is that Apple and Google hire more engineers from San Jose State University than any other college in the country. Finally, and most importantly, we want to do business in places where the local government wants to see development happen. And that is absolutely the case in downtown San Jose. You know, it's quite a challenge to get your building permits in California, but in downtown San Jose, they've made that process streamlined and extremely easy so that you have clarity going through the process. And this picture here is a picture of my partner, Josh, and I. We're with the mayor of San Jose, Sam Liccardo. He's been the mayor for 6 years. Before that, he was the council member representing downtown San Jose for 8 years. And it's really the policies that he's put into place that make development so much easier in the downtown area. Now, when I talked about those macroeconomic trends pointing to downtown San Jose as the next place to do development, what I'm talking about is the tech migration in Silicon Valley. I always like this slide because everyone knows that Silicon Valley, you know, has a lot of technology companies, but when you see just how many companies have their headquarters or a major office presence here, it's just really impressive. For this example, I'm specifically going to talk about what we call the FANG companies. That's Facebook, Amazon, Apple, Netflix, and Google. You know, over the last 10 to 15 years, these companies have just been growing at an enormous rate. And they've come to realize something, which is it's very difficult for their employees to afford to live here in the Bay Area. We have some of the most expensive housing in the world. You could call Palo Alto the center of the Silicon Valley universe. The average housing price in Silicon Valley, or in Palo Alto, is $2.5 million. And Facebook, who pays their employees very well, the average Facebook employee, it would take them 28 years to save up a down payment to buy a house in Palo Alto. So most of them don't live in Palo Alto. They live here in San Jose or just south of downtown, and they commute to Palo Alto to work. You know, it's only 15 miles from San Jose to Palo Alto, but in traffic, that can take an hour to an hour and a half. And even though, you know, these companies have their own private bus systems with Wi-Fi, they're seeing that they lose, you know, efficiency with having their employees on a bus for 2 to 3 hours a day. And, you know, those employees, they don't want to be on a bus for 2 to 3 hours a day. The new millennial tech employees, you know, they want to ride their mountain bikes to work. So in the competition amongst these tech companies to get the best talent, having a headquarters where it's closer to where they live is important. So all of these companies have embraced what we call a decentralized headquarters strategy. And in the last 10 years, they've made a big movement towards where their employees live, acquiring office and developing new office in the city of Sunnyvale. Sunnyvale development has just been going like gangbusters for 10 years. And now development is, you know, really done. The city's almost completely built out. And to give you a scale of really what I'm talking about, here in the city of Mountain View, Google owns or leases 95% of the office space. Here in the city of Cupertino, Apple owns or leases 85% of the office space. And now with this big movement, Google and Apple combined in the city of Sunnyvale have more than 50% of the office space. But now that Sunnyvale is done growing, where are these companies going to continue to move as they grow? And the answer is literally the next stop on the train, which is downtown San Jose. We've already seen Amazon and Apple come to downtown, and we've seen Google make a massive move into downtown. And what has happened to downtown San Jose over the last 10 years because of this tech migration? Well, from an office perspective, we've seen office rents double in the last 10 years. And at the same time, we've seen office vacancy rates, which were above 20% for over 2 decades, drop below 10%. And that 10% line, that is really when a market changes from a tenant market to a landlord market. To continue talking about what's happening in downtown, I want to show everyone this map of downtown San Jose. This black line represents the Opportunity Zone. Here is Urban Catalyst headquarters. We're located right in the heart of the Opportunity Zone in downtown San Jose, right next to Adobe's world headquarters. Adobe has been a long time downtown San Jose tenant. They have been downtown for over 27 years. Right now, Adobe's in the process of building their 4th high-rise office tower right here. Here's San Jose State University. This is where BART is going to connect through downtown under Santa Clara Street, a couple stops downtown, and connect into Diridon Station, the train station. This is the SAP Center. You know, we call this the Shark Tank because this is where the San Jose Sharks play hockey. And of course, you can't miss it on this map. Here in purple, this is Google. In the last 24 months, Google has purchased over $450 million worth of property in downtown San Jose. That's over 80 acres. And their plan that they've submitted to the city is to build around 7.5 million square feet of office and 5,500 residential units. At build out over the next 10 years, this will be Google's largest campus on earth, with over 75,000 people coming just to their campus every day. So it's a huge move by Google to be near transit and in a place where there is room to grow. Also, I want to point out on this map here in orange, this is J. Paul. J. Paul is a large office developer. And in the last 12 months, they've purchased $650 million worth of property in downtown San Jose. Their plan is to build 5 million square feet of office. And, you know, here at Urban Catalyst, you know, we had an idea, which was we want to come into downtown San Jose, we want to acquire properties to do ground up development and really get in on the ground floor before the wave of developers and big tech companies got to downtown. And that's exactly what we did. We acquired 7 projects in downtown San Jose. We're scheduled to start construction on all 7 of these projects in 2021. Over here in the Diridon Station area, right next to Google, we have 3 projects clustered together. This is a Marriott Town Place Suites extended stay business hotel. This is a 8-story residential multifamily project. This is a senior living facility, and even more specifically, it's assisted living and memory care. Here in the core of downtown, we have 2 office projects. This is a high-rise residential project, and this is a high-rise student housing project right here next to San Jose State. So you can see we have a very diversified set of asset classes, really to reduce the overall risk of our portfolio. You know, what makes Urban Catalyst different than other Opportunity Zone funds is, you know, a lot of other funds, their plan is to go out, raise $1 billion, and then scramble around the country looking for developers to partner with that have projects in Opportunity Zones. Here in Silicon Valley, you know, we look at Steve Jobs and Steve Wozniak, and we say, did these guys go out and raise a bunch of money and then hire someone to build them a computer? And the answer is no, they built a computer and they took it out to the market. And that's exactly what we're doing here at Urban Catalyst. We're not just fund managers, we're also developers of all 7 of our projects. And we have 7 projects in our portfolio, and now we're taking those projects out to the market to raise money to build them. Also, something important to mention to all potential investors into an Opportunity Zone fund is, you know, the Opportunity Zone tax benefits they're great. We're big fans. Some people have called the Opportunity Zone program, you know, a once in a lifetime tax advantage. And, you know, that's great. But what really matters when you invest into an Opportunity Zone fund is the underlying real estate. Because if the biggest benefit of the program, the biggest tax benefit is that you get tax-free profits after 10 years, well, there better be profits after 10 years, or else what's the point of the entire program? So it's important to know what are the real estate assets that are in the fund and who are the developers that are building those projects, because developers' track record and experience is really the best indicator of future success. So here at Urban Catalyst, we look at ourselves as a solid fundamental real estate equity fund focused on ground up development, and we see the Opportunity Zone tax benefits really as just the icing on the cake.
Yeah, fantastic, Erik. I think this is a good time to interrupt you here before you dive into the details on your 7 downtown San Jose Opportunity Zone projects. I want to interrupt you and get our second poll question up for our audience today. So this is a question that I've been asking a lot recently. So if you've been on any of my webinars previously, this one will be very familiar to you, but we were just talking about some of the benefits of opportunity zone investing, the tax incentives in particular, but there's a couple others to keep in mind as well. There's a social impact component, and of course there's an ROI component as well, which Erik was hinting at, and he's going to dive into in more detail on the second half of the presentation today. Which of the following best describes your primary motivation as an opportunity zone investor? If you had to pick just one, which one is the most important to you? The social impact component, the ROI, or is it the tax incentives? This being, as Erik mentioned, potentially the tax advantage opportunity of a lifetime. So we'll give everybody just a few more seconds to vote on that, and then we're going to dive into the second half of Erik's presentation, where he's going to walk you through each of the 7 projects that Urban Catalyst is working on in downtown San Jose. So a couple more seconds here, get your vote in, and we're going to end the poll and share the results. And it does look like, hey, look at that, Erik. We've got a majority of people who are most interested in the ROI, with a fair amount of people also interested in the tax incentives and the social impact as well. I would suspect that most of the attendees here are interested in at least 2 of the 3, and perhaps all 3, but the most important one being that ROI. That's really what drives the tax benefits on the back end anyway.
And that's, what I would expect and what I would hope. When people are making investments, of course, they want to know what their return on investment is. And, whenever you invest into a fund that has tax benefits, you don't want the tail to wag the dog, right? You don't want the tax benefits to put you into a program. You want it to be a good program that has some extra benefits with taxes.
Right. One more reminder for everybody before you continue, Erik, is that we are going to leave some time at the end of the presentation today for some Q&A. So if you have a question for Erik about opportunity zones in general, or about any of his projects, or about the San Jose market, please do use the Q&A tool in the Zoom toolbar it'll be at the bottom of your screen on most platforms, I believe, and submit your question. We'll ask it live to Erik at the end of the presentation today. So Erik, please continue. Thank you.
Sure. So as Jimmy mentioned, I'm now going to talk about our 7 projects in more detail. Our first project, the Fountain Alley building, this is located in the historic area of downtown San Jose, right between 1st and 2nd Streets. It's an office project over ground floor retail. You can see we're stepping back the retail from the street so that we can have outdoor dining and really attract a quality restaurant tenant. You can't miss our 5,500 square foot rooftop bar, which is going to be, when complete, the largest rooftop bar in Silicon Valley. When we announced that, we got just a ton of press. People are very excited here in San Jose about rooftop bars, and they should be. We don't have a lot of them, and we have 300 days a year of sunshine in San Jose. It's some of the best weather in the country, so we'll definitely be able to utilize that on a year-round basis. Also, last December, we purchased this little 3-story historic building on the right. This building is going to be the main entrance to our office building. So you can imagine walking into a beautiful historic facade and lobby, and then taking your elevator to your modern office space. Our next project, this is the Keystone Hotel at Downtown West. This is the Marriott Town Place Suites I talked about. We signed our franchise agreement with Marriott at the end of last year. We've done 3 of these projects in our career in Silicon Valley, so we have a lot of experience with the extended stay format. And for those of you that aren't familiar with what an extended stay business hotel is, typically it's for long-term stays for business travelers. Our average guest stays for 15 days, and every single room has its own kitchen. Because of the just uptick in overall office usage in the downtown area, we've seen just an extreme amount of demand for this type of project. Of course, that was pre-COVID. Hotels and retail have just really been hit pretty hard because of the pandemic, and we totally understand that here at Urban Catalyst. One thing to point out about this project, it's not going to come online until June of 2023. And by then, the pandemic should have passed, and we should have a more normalized demand profile for hospitality. So we're not concerned with the timing of this project. In fact, having COVID hit now instead of in 2023 is somewhat beneficial to us, as we're not building or leasing or having rooms go into a market during the pandemic. Right across the street from our hotel project, this is MADERA at Downtown West. Of course, all three of these projects that I'm talking about, the hotel, Keystone Hotel, MADERA, and our senior living, those are the cluster of three projects that are right next to Google over in the Diridon Station area. So this project is an 8-story building, 140 multifamily units. I personally have built 1,000 multifamily units within a half a mile of this location. So this is really right in the middle of my wheelhouse. Here in California, we have a housing crisis. You know, I talked earlier about how expensive it is to live, and that's absolutely true. And the reason is we just don't have enough houses for people to live in. We've been creating here in Silicon Valley 5 jobs for every housing unit that we've built for over 30 years. And that trend is accelerating. We literally can't build residential fast enough. So this is Urban Catalyst. Of course, we're doing our part to help solve that housing crisis by building more market rate multifamily here in the San Jose area. As I mentioned, right down the block from our multifamily project, this is the Delmas Senior Living Facility. This is assisted living and memory care. We've done 6 of these projects in our careers in Silicon Valley. We've used the same operator for all 6. We're very familiar with how to design and operate this type of facility. You know, they haven't built a project like this in downtown San Jose in over 35 years. And with the aging baby boomer population, and of course, this project's proximity to some of the more affluent neighborhoods of San Jose, just a lot of demand for this type of project. You know, you can imagine if you lived in one of the surrounding neighborhoods and you wanted to put your parents or grandparents into a building like this, you know, you're looking at a 6 to 12 month waiting list for a project that might be a half an hour to an hour drive away. Right in the core of downtown, across the street from City Hall, is our icon at Civic Center. This is a residential high-rise project with some office and ground floor retail. This is Santa Clara Street. As I mentioned, Santa Clara Street is where the BART line will be running. And in fact, these green awnings that are here right in front, this is the existing Starbucks. And the new portal to the underground BART station is going to be located right in front of those. So this project is literally being built next to a mass transit stop, which makes it the epitome of transit-oriented development. Of our 7 projects, 6 of them are ground-up development projects. This one, Paseo, is our only renovation. We're changing a 12-screen movie theater into 2 floors of office with ground floor retail. This project is located on the Paseo de San Antonio, which is a major pedestrian connection between San Jose State and Cesar Chavez Plaza. It's located right behind the Fairmont Hotel and arguably the best office location in all of downtown. Recently, 2 prominent San Jose restaurants that have been longtime downtown San Jose tenants moved onto the Paseo de San Antonio, and we're planning to add to that with 2 full-service bars and restaurants as our ground floor tenants, really creating a restaurant row along the Paseo. In the upper floors of this building, you know, because it used to be a movie theater, our average floor to ceiling height is 24 feet. And that allows us to do some pretty special things for our future office tenant. Things like building out floating conference rooms, mezzanine levels, and catwalks that connect to our rooftop gardens. Finally, our 7th project, this is the Mark. The Mark is a student housing high-rise. When it's complete, it'll be 800 student housing units. This is right next to San Jose State University. You know, San Jose State has really been going through a transformation in the last 10 years. 10 years ago, it was really a commuter school where people lived at home and commuted into class. Now it's a lot more likely when you're accepted to San Jose State, you're going to move to San Jose to attend college. And you know, you combine that with the housing crisis, and it just creates a lot of demand for student housing. Over the last 10 years, the university has not built enough student housing to meet the demand. In fact, their own internal studies show they need about 6,000 student housing beds. Recently, a 1,000-bed student housing high-rise was completed about 2 blocks from here. It's called The Graduate. My partner, Josh Burrows, at his previous company, built that high-rise. So we have a lot of experience building high-rise student housing right next to San Jose State. To give you an example of just how intense the demand is getting for student housing here in San Jose, there was a survey done last year of San Jose State students, and 13% responded saying that in the previous 12 months, they had experienced homelessness. And to combat that, the university now has parking lots on campus that are designated for students to sleep in their cars. And they have security guards that watch them at night to make sure that they're safe. But you can just see building 800 units into this market, boy, we're taking a small dent out of that demand, but really not even getting close to meeting it. It's a big problem in San Jose, and we're very pleased that we're able to help solve at least a portion of that problem. Also with this project, we have been in conversations with San Jose State University about having a partnership with them to do a master lease, because having a credit tenant with a long-term lease obviously reduces the risk of a project. So those discussions are ongoing. I'm going to change gears and talk a little bit about, our timeline. Almost all of our investors want to know, of course, how long are you raising money? When would we expect our first distributions? Why are you making distributions prior to the end of 10 years? What happens after 10 years? So let me go through this really quick. And of course, during the Q&A session, if you have more questions, I'm very happy to revisit this. So for this fund, we're raising money in 2019 and 2020. We closed the fundraising portion of this fund on December 30th of this year. To date, we've raised almost $70 million. We're targeting raising $105 million by the end of this year. I mentioned we have over 150 investors. Our minimum investment size is $250,000, and I'd say our average investment size is a little bit over $500,000. The first time we plan to give money back to our investors is part of our refinance and distribute program. And let me explain that. It's kind of developer 101. We build our buildings, we lease them up, they stabilize, we go out and we get permanent financing. We take that permanent financing, we pay off the construction loan that we use to build the building, and then any excess refinance proceeds, we're able to distribute those to our investors. Right now, we're targeting distributing 80% of our investors' initial investment back to them between 2023 and 2026 as our projects come online.
Do you find that, sorry to interrupt you, do you find that that's particularly important given that these investors are going to need some liquidity in April 2027 to pay their deferred taxes?
Jimmy, I'm glad you brought that up. That is a question that we get all the time is investors want to have some returns to pay their taxes in 2027. They don't want to have to come out of pocket to do that. And the way that our fund is structured as a partnership, we are able to do this type of distribution, which should allow us to be able to give them enough distributions to pay their taxes in 2027. Of course, nothing is guaranteed when you're investing into any type of fund. Another interesting thing, Jimmy, about the Opportunity Zone program in general, because of the 10-year hold to get tax-free profits, really creates a hybrid type of fund. In the first 5 years, we're more of a value-add fund, where we're creating value through ground-up development. In the second 5 years, we're more of a core fund, where we have stabilized assets and those assets are cash flowing. So in the second half of the fund, we'll have cash flow to distribute to our investors. And you can see there where it says bracket with depreciation. So anytime you own real estate, you depreciate your real estate on your taxes every year. So you're able to write it off, and it's a loss, which is great because losses offset income. Because we're structured as a partnership, we're able to pass through that depreciation to our investors. In fact, we're targeting having more depreciation than cash flow in the second 5 years of the fund, which would make most of the cash flow that we're distributing tax-free. Finally, after 10 years, we're going to sell all of our projects, liquidate the fund, and that's the big win for our investors. That's when they receive the majority of their profits, and that's tax-free from a federal capital gains perspective. And Jimmy, one additional thing I wanted to mention, which is, we're talking about depreciation specifically for Opportunity Zone funds. And this came out as a part of the December 2019 final round of guidelines from the Treasury and the IRS, is for Opportunity Zone funds, we are not required to pay back that depreciation that we're taking on our buildings. And this is something that is really a great tax benefit for our investors that didn't get a ton of press, but it is really important to know. Because typically when you sell real estate, you have to pay back that depreciation. For Opportunity Zone funds, we have no depreciation recapture.
Right. Yeah, that's a huge hidden benefit. I've referred to it as over the past few months here, depreciation recapture elimination. Sometimes you need to be a bit of a tax geek to even understand what that is exactly. The average investor might not be terribly familiar with it unless they have a lot of experience with real estate investing. But it is an enormous benefit that, you're right, doesn't really get a lot of attention. It's not as big as the appreciation or the capital gains elimination on the back end, but it's still a pretty sizable benefit, especially in a deal like yours, Erik. I agree.
Absolutely. So now I'm going to talk about our team here at Urban Catalyst. I formed Urban Catalyst, and my plan was to create an all-star team of downtown San Jose developers. And that's exactly what I did, bringing on Josh Burrows and Paul Ring. Josh is our Chief Operating Officer. For 12 years prior to becoming a partner at Urban Catalyst, he worked at Barry Swenson Builder as their lead developer, managing their entire downtown portfolio. And there he got a lot of experience building a variety of different types of projects. Paul Ring, well, I've known Paul for over 10 years. He's our Executive Vice President of Development and Construction. I had the unique opportunity of working with Paul when he was at the Core Companies. The Core Companies is a downtown San Jose developer that specializes in multifamily and below market rate housing. Paul and I were joint venture partners on 2 multifamily projects, and I got to see Paul, manage his team of consultants and developers, and I was just really impressed with his style and really wanted to bring him on as a partner. And now he manages our entire team of developers, over 12 people, doing the development and construction of our projects. Of course, we're not just developers, we're also fund managers. I brought on Morgan Mackles. He's our Executive Vice President of Investor Relations. Morgan and I have known each other for over 26 years. We went to high school together. I recruited him back from New York to work here and be our partner at Urban Catalyst. Morgan has spent his career building sales teams for not only startups, but also for Fortune 500 companies. He's an expert at building scalable and repeatable sales processes, and he is one of the main reasons how we've raised almost $70 million to date. Sean Raft. Sean is our Chief Administrative Officer. Sean started his career as an attorney as a public defender in Los Angeles County, and at trial he went 126-3. And I like to say that about Sean because it just shows what kind of a person Sean is and just how much he has his act together. Here at Urban Catalyst, Sean manages all of our financial consultants, our accountants, our attorneys, and our fund administrators. Or what I like to say about Sean is that he really dots the I's and crosses the T's here at Urban Catalyst. Combined, we have done almost $6 billion worth of acquisition in Silicon Valley. We've done almost $5 billion worth of development projects. You can see the heavy concentration of development projects in downtown San Jose. Here are some examples of some of the projects that we've worked on throughout our careers. And I'll specifically talk about this project. This is the Brooklyn Basin Master Plan in downtown Oakland, just south of Jack London Square on the waterfront. Prior to starting Urban Catalyst, I was the president of Zarshan America. This was Zarshan's largest asset in the United States. I managed a team of 11 people, and in the 5 years I was there, we did roughly $200 million in infrastructure improvements to this 64-acre master plan. At build out, this project will be 2,300 residential units and around 200,000 square feet of retail. Also, while I was there, Zarshan broke ground on one of the vertical components of the project, this project here, which is a 244-unit apartment building. The total project cost for that project was $130 million. I went out and sourced financing to build this project. I got $80 million in senior debt from Bank of the West, syndicated to City National Bank, and I received $37.5 million in preferred equity from Essex Property Trust. Zarshan put in the rest, and that project started construction just as I left to form Urban Catalyst. So here at Urban Catalyst, we have a philosophy that we brought with us from being developers, which is in order to do a project the right way, you have to bring in the best service providers, consultants with the expertise and experience in their specific fields. Here at Urban Catalyst, Goodwin Procter is our attorney. Goodwin Procter, a very large law firm nationwide. And when I first started Urban Catalyst, there were only 10 other multi-asset opportunity zone funds operating in the United States. And Goodwin had structured over half of them. So really the go-to group for structure and tax for opportunity zone funds. We work with Nova Gradic. They are our accountants. They do our tax and audit. They've really branded themselves as the Opportunity Zone Fund accounting firm. Both Goodwin and Nova Gradic have members on that national working group that advise the Treasury and the IRS on any ongoing Opportunity Zone clarifications as part of the legislation. And recently, our own Sean Raft was appointed to that group. So now we really have an inside ear as to what the federal government is doing and thinking about the program. Finally, NES Financial. NES Financial is our fund administrator. They monitor every dollar that goes in and out of the fund, representing our fund investors, just making sure that we are not only meeting the Opportunity Zone guidelines and rules, but we're also meeting our own private placement and our SEC regulations. So in summary, today I talked a little bit about the Opportunity Zone program. I talked about why we're doing business in San Jose, the overall story of downtown San Jose and the market. We went through Urban Catalyst portfolio of 7 projects, very diversified set of asset classes. And then finally, we talked about our team and our experience doing projects as developers and fund managers. And so with that, if you want more information, please visit urbancatalyst.com. And Jimmy, I think you got another poll question for us.
I do, yeah. Well, thank you, Erik. That was great presentation. Before I do the final poll question, a reminder for everybody, we are going to send a follow-up email to everybody tomorrow with access to the recording of this presentation. If you want to watch it again, or if you weren't here at the beginning, you can watch the recording. We got to get it all fixed up and looking good, and then we'll get it up and running. We'll send that email out there tomorrow. So yeah, please do head over to urbancatalyst.com to learn more about the fund. And we're going to move into the Q&A portion in just a minute here, but I did want to ask our final poll question, as Erik alluded to. Do you plan on investing in the Urban Catalyst Opportunity Zone Fund within the next 6 months? We got yes, no, or still doing research. So we'll give everybody a chance to answer that poll question while we move into the Q&A here. So we've got a lot of good questions that have come in. A reminder, if you do want to submit a question, please click the Q&A icon in your Zoom toolbar, and you can just type in a question and I'll read it out to Erik. So let's see, Erik, question here from Carmen. He asks, what if San Jose is removed from the Opportunity Zone list in the coming years? Is there any potential for you guys to get in trouble there if it gets removed?
So overall, when we talk about the removal of opportunity zones, there were a couple of senators, really Democrat senators, that were talking about something like that. Nothing has really ever come to fruition. I mean, obviously to change the program, it takes a literal act of Congress. And if you look at the roots of this program, it really is a bipartisan program. It came out of a think tank that Sean Parker, he's the founder of Napster, and he's a Democrat. His think tank came up with this idea. There was a Republican and a Democrat that sponsored the bill. It didn't go through the Obama administration, went through the Trump administration. So definitely very bipartisan to start off early. And since then, there's been a lot of talk about it, but overall, the program itself is starting to really show that it is proving the benefits that the government wanted to see when it was enacted. And we don't see any movement on really any of the ideas to remove certain zones from the program itself. Now, to answer your question kind of a more direct way, if a zone is removed, there's always the idea that that zone could have grandfathering clauses for our different, for developers and opportunity zone fund managers that are doing development in those areas. And then finally, if it's removed outright, the only thing that would happen with our fund is that our investors would owe money on their capital gains taxes in the next calendar year, and that at the end of 10 years, they more than likely would not get their tax-free profits. But overall, they'd still be invested in a real estate equity fund that's doing ground-up development projects in downtown San Jose.
Yeah, great answer there, Eric. I agree with you. I do think it's highly unlikely that it would get removed to the extent that the benefits would just disappear for particular investors. I do agree there'd be some grandfathering in. I don't see it being very likely that the Zunes will be removed at all anyway, though. Question here from Constantine. He actually has a comment. I want to ask you if you agree with it or not, Eric. He says CBRE analysts are predicting that the lodging sector will be back to pre-COVID-19 levels in approximately 24 months. What are your thoughts there?
You know, I've seen that same report, and I've seen across the country that the hospitality sector is already recovering pretty strong. I mean, they're not back to the level they were pre-COVID, but it is the demand for hospitality is increasing. 24 months, I think that might be a little bit conservative. I think it might come back a little quicker, but obviously it depends upon when it's safe for everyone to congregate again, and knowing, you know, when we're going to have a vaccine or when we'll have treatment that makes it, you know, less likely that everyone would have more severe reactions to the pandemic. Those timelines probably have a lot to do with it. So I guess my answer overall, 24 months, yeah, that's as good an estimate as I've seen out there, and I think you can rely on that.
Good. So Eric, quite obviously, your investment thesis relies on the premise that tech migration will come into San Jose and that they're going to continue to expand their need for office space. But Mike asks, what's your thought on COVID potentially causing companies like Google or Adobe or all those other tech firms rethinking office space, rethinking the concept of needing to expand their office space and instead having workers stay remote for a long period of time?
Well, you know, that's a question that, of course, we've been thinking about ever since the pandemic started. And, you know, what we do is we look at what the big tech companies have been saying. And the first part of COVID, you know, when we all started working from home from Zoom, and it was very much a novelty, and we saw that, you know, we could be productive from home, there was a lot of talk about companies working from home, you know, indefinitely. I mean, Twitter came out and said that, and so did Facebook. Facebook came out and said that 50% of their employees are going to work remotely. They're going to transition that over the next 10 years. Lately, we've been seeing a lot of more of these tech companies saying that, just reaffirming that they're going to be utilizing physical office as a big part of their program moving forward. Both Adobe and Google have come out and said that their workers will be coming back to the office when it's safe. Now, Google came out and said their employees don't have to come back to work until July of next year. And obviously, you know, they're thinking that it'll be safe for them to return them, but Google's a big believer in having their employees work in the same. That's how they find they get that interaction and those ideas that create their moonshots for all of their different types of projects. Looking at it from a different perspective is people, when they come back into the office, you know, especially initially, are going to have to socially distance. How much space does it take to socially distance in the office spaces that these tech companies already have? And to give you an example of kind of the scale of all of this, about 15 years ago, the average square foot per employee in Silicon Valley was around 400 square feet. So that's back when everybody had cubicles and there were a lot more private offices. In the last 15 years, we've really been putting a lot more people into a lot less space. Right now, Google and Facebook average one employee per 150 square feet. You know, is that trend going to change? Is it going to be that in order to socially distance, you need to have one per 200 square feet, one per 250? Is that going to make it so that you can bring back some of your employees, but not all of them? So you are going to, of course, have some employees that are still working from home, but you're also going to be maximizing the amount of office space that you currently have. So this dynamic, I mean, obviously the pandemic has only been going on for 5.5 months, and it remains to be seen. You know, nobody can predict the future, but we do see those offsetting trends of the requirement to social distance along with working from home somewhat offsetting each other.
Good. Yeah. Good Good answer there. Move on to the next question here from Vera. She's got a handful of questions, actually. I'm gonna throw each one of them at you. I'll go one at a time. She asks, now that real estate is down, is an opportunity zone investment going to be worth it for investors?
So interesting when you talk about real estate being down. In downtown San Jose in July, 2 high-rise office buildings sold, and one was an office building and one was a apartment building, but they sold for record pricing. They set new high water marks in downtown San Jose for the most expensive buildings ever sold. So what we're seeing isn't necessarily a real estate market that is going down. What we're seeing is a lot of the institutional investors that buy existing buildings, they see San Jose as the flight to safety. You know, they understand that Silicon Valley has a strong economy, that typically, you know, historically, we've been the last to go into a recession and one of the first to come out. And also, there's been a lot of articles recently. We saw one in Bloomberg, we saw one in Forbes that rank which cities will be the first cities to recover from the pandemic. San Jose is in the top 5 in all of those articles, and Bloomberg had it as the #1 city to recover. So from an overall real estate perspective in downtown, you know, we're seeing some asset classes are really taking off. Others like hotels and retail, obviously they're being hit pretty hard by the pandemic. But, you know, Jimmy, it's interesting, as real estate developers, you know, we're not buying existing assets. And, you know, a lot of people talk about when they're looking to invest in a fund, they want to wait until there's a recession, and then they're going to invest into a distressed asset real estate fund, because that's really how they're going to get great returns. And to define distressed real estate fund, you know, you might say that that fund is going to purchase existing real estate assets for 15 to 25% off what the market rate value should be. Here at Urban Catalyst, we're building buildings. And what we have seen in the market historically is that during times of recessions like this, we see construction cost decreases. In 2008, construction costs decreased in Silicon Valley by 20%. If we see something like that happen here because of this pandemic, that'd be a significant cost savings to our investors. I mean, we have over $500 million in hard cost constructions as a part of this fund, and that's $100 million cost savings. Typically, we see construction costs go down, you know, 9 to 18 months after a shock to the system, because subcontractors have a pipeline of projects that they're working through. And so we wouldn't expect to see those construction decreases yet. However, we're already seeing them. We're seeing several of my general contractors have told me that their latest bids are 5% reductions, and they're expecting 8 to 10% reductions on their bids that are coming in this month and next month. So that softening is already starting to happen. We were never set up to be a distressed asset fund, but as developers building buildings for significantly cheaper, we are looking like we will be a distressed fund, at least in the general terms of, you know, building buildings for a significant reduction in price.
Yeah, well, that makes sense. So if anything, you know, potentially the market downturn or the softening may in a way be helping you and your fund and your investors.
That's absolutely right, Jimmy.
Yeah, a couple more questions from Vera. I'm letting her get hers in because she asked them early on. She wants to know, I'm going to throw all these at you at once here. How much will an investment in your fund save her in taxes in the first year? Second, does she get to choose the project? And third, is she able to withdraw her money at any point? I think I touched upon that a little bit on that one timeline slide, but maybe you can go into it again here.
Sure. So our fund is a 10-year hold. Our investors do not have the ability to take money out of our fund. The way it works, of course, is because we're buying illiquid assets, which are real estate. If, say, there was a recession and our investors had the ability to take their money out, there might be a run on the fund that would force us to sell our assets prematurely. So our investors do have some rights to take money out after the 10-year period. It is very limited. However, our plan is to maximize their returns by selling all the buildings as close to 10 years in one day as possible, because it's in our best interest as fund managers to maximize the returns for our investors. Next question, Jimmy, remind me what the other question was?
The other question was, hang on, I hit it here. Oh yeah, does she get to choose the project? If you're an investor in the fund, can you choose which specific projects you can be invested in, or are you getting all 7?
So the short answer is you're getting all 7. All of our investors are invested equally pari passu into all of our projects. You know, we are a multi-asset fund, so investors do not get to choose which asset to invest in.
And then I think you answered the question, can she withdraw her money? Generally, no, right. So let's see. Next question is from Dinesh. And Dinesh asks, could you please talk a bit about how the GP and LP interests are aligned? Are cash flows to general partners milestone driven?
So yes, the GP and LP interests are aligned. The first way that they're aligned is that as fund managers, we have a significant investment directly into the fund with our own money, over 2%, which makes us fund investors right alongside our investors. The second is that our fee structure is set up to incentivize us to maximize their returns. And really, you know, we are fund managers. We do make money from fees. The majority of the fees in this fund come as a part of an 80-20 profit split after our investors receive their money back plus an 8% return. We get 20% of the profits, they get 80% of the profits. And that's when the majority of our fees come in, so that we win alongside with our investors. So that's the 2 ways that we're incentivized. The LP and the GP are incentivized together.
And that's a pretty typical structure for a private equity deal or an opportunity zone fund such as yours. Is that right?
Absolutely. They call it the 2 and 20, which is 2% management fees and an 80-20 split after a certain return hurdle.
Yep. We've got just a couple more minutes here, and then I'm going to cut everybody loose, but we got a few more questions I'd like to get to. If we don't get to your question, by the way, I don't think we're going to be able to get to everyone's question. I am going to forward them on to Erik and his team, and they'll try to reach out to you as soon as they can. But Laquavius asks the question here, is it necessary for Opportunity Zone to sell off assets at the end of the 10-year hold period? How does that work exactly?
So the rules are not that opportunity zones have to sell their assets after 10 years. That is how our fund is structured. You know, in the beginning of the presentation, I mentioned that we're a private equity fund that's focused on ground up real estate development. And typical for private equity funds is we're looking to maximize the internal rate of return to our investors. So that means getting them as much money back to them as fast as we can. Because we have the 10-year hold, we're going to sell all of our projects, you know, right after that 10-year period. There are other structures for opportunity zone funds out there that are based, you know, they're more like longer term REITs that are based around receiving tax-free cash flow. The program itself goes through 2047. So there would be a lot of time to be able to get tax-free cash flow after 10 years. That is not how our Urban Catalyst, however, is structured.
Good. We've got an anonymous question just came in that's interesting. Notice that you're not raising any money beyond 2020. Why is that? And is it because maybe you're going to have a second round of funding, maybe a second fund, or what are your plans beyond 2020?
So the main reason why we're closing the fund at the end of this year is because we plan to hit our fundraising goal. And the second really is, you know, we're raising for 2 years, and that 10-year clock that starts, well, at the end of the 10 years, you know, you get the tax-free profits. That clock doesn't start until our last investor invests in the fund. So our investors that invested in early 2019 are really waiting 12 years. And we don't think it's fair to those investors to have to wait any additional time to get their tax-free profits out of this fund. So that's why we're closing the fund. Now, as far as future funds, we don't have any current plans for future funds. That isn't to say we won't announce them, but at this time, we only have this fund available.
Okay, good. And final questions here from Ernst. He's got a few numbers questions for you. Why the minimum of $250,000? And then he also wants to know if you have any projections on IRR or cash on cash total return.
Sure. So the minimum of $250,000 is because you know, there's only a limited amount of time and people and space available when you raise money. And we found that 250 is usually not even something that our investors really blink an eye at. It's more, like I mentioned, our average investor size is over 500,000. So the 250 minimum has never really been much of an issue with our investors, but it has to do with the number of investors we're going to have in the fund. And just like I said, our our ability and our time to raise money. The second question, projected returns. because this is a recorded event and we do meet FINRA regulations, I cannot describe what our projected returns are.
But I would encourage, if you do have questions, to get in touch directly with Erik and his team.
Absolutely. Feel free to give me a call, and I'd love to have that discussion.
Yeah, so please do visit urbancatalyst.com, and there's a contact page there where you can leave your information, and Erik can get back to you with very specific answers to those questions. Erik, any final words here before we go today? Otherwise, I'm gonna wrap it up. We're a couple minutes after the top of the hour here.
No, I just want to say thank you again, Jimmy, for having me on your program here. And thank you to everyone who tuned in to learn about Opportunity Zone Funds and Urban Catalyst.
Yeah, absolutely. And thank you to Urban Catalyst. Thank you to Erik Hayden and your team behind the scenes who worked hard to put this together with me. And of course, as Erik mentioned, thank you to all of our attendees here today. A reminder, we will get a link to the recording out to you. We'll send a follow-up email with all of those details tomorrow. And if you have any questions in the meantime, please do head over to urbancatalyst.com. Thanks, everybody.
Hey, thank you.